We are counting down the 10 Australian cities most at risk of a mortgage meltdown by 2026. From coastal hotspots suffering a wage and insurance squeeze to commuter belts buckling under debt, each entry faces a unique cocktail of financial stress. Some are already seeing price slides, lies, and record foreclosures, while others may surprise you with just how fragile their foundations have become. Which city faces the most severe reckoning? Let us begin with number 10. On the Gold Coast, the dream of home ownership is colliding with harsh financial realities. Tourism and hospitality jobs, which make up nearly a tenth of local employment, offer some of the lowest wages in the country, often under $800 a week. In growth suburbs like Commuter and Pimpama, many families took out large mortgages during the boom, only to be hit with soaring insurance premiums as flood risk maps were updated. A typical household now faces not just repayments approaching $5,000 a month, but annual insurance bills that have jumped by $1,500 or more, often topping $2,500 a year. For workers on modest incomes, this double blow leaves almost no room to move. The numbers simply do not add up. Hobart's housing market soared during the remote work boom, with prices climbing faster than any other capital city from 2019 to 2022. Buyers from the mainland, often earning double the local wage, pushed values to record highs. But as remote work fades and those big city salaries leave, Hobart is left with a sharp mismatch. Property prices remain high, while Tasmanian incomes, the lowest of any state, can't keep up. CoreLogic data shows prices have already fallen nearly 12% from their peak, yet the gap remains too wide for most locals to bridge. Turnover has slowed, trapping many recent buyers in negative equity. Newcastle's property market rode a wave of migration from Sydney during the remote work surge, with CoreLogic data showing prices climbing sharply through 2020 and 2021. Many new buyers relied on Sydney-level salaries to justify six-figure mortgages. Now, as employers pull workers back to the city, those assumptions are collapsing. Commuting costs have soared. Fuel, tolls, and train fares eat into already tight budgets, while Seek wage ads reveal a growing gap between local and Sydney pay rates. Households who once had a buffer now face repayments that outpace their income, with little hope of refinancing or selling at a profit. The commuter dream is turning into a solvency crisis. Geelong, pronounced Geelong, is facing a downturn that cuts across nearly every suburb. CoreLogic data shows price declines are now widespread, not just isolated to the outer fringe. The city's rise was built on the promise of Melbourne salaries with a regional lifestyle, but as remote work fades and commuting becomes the norm again, that foundation is crumbling. Most households here depend on incomes tied to Melbourne, yet mortgage repayments have doubled since 2022. Newer estates, packed with volume-built homes, are grappling with a wave of builder insolvencies and construction defects, making resale even tougher. For many, the combination of falling prices and rising costs is locking families in, with no easy way out. Adelaide was once the benchmark for affordable Australian cities. That changed rapidly after 2020, when house prices surged far ahead of local wages. Domain reports the share of household income needed to cover mortgage repayments has jumped from 27% in 2019 to 51.5% in 2024. This is one of the sharpest deteriorations in the country. ABS data shows that wage growth has barely budged in the same period, leaving new buyers exposed to a repayment burden that is now well above the national comfort threshold. Even with smaller average loan sizes than the East Coast capitals, Adelaide's citywide affordability metrics have collapsed. The numbers reveal that so-called safe markets are now facing the same solvency pressures as their more volatile counterparts. Perth's housing market sits on a fault line few other capitals share. Western Australia's economy is built on mining, with Perth as the nerve centre for iron ore, nickel, and lithium projects that drive the state's fortunes. Even though only 5 to 6% of Perth's residents work directly in mining, the city's outer suburbs are home to thousands of FIFO workers and mining professionals. When commodity prices dip or companies tighten budgets, the first signs appear as cutbacks in overtime, contractor hours, and project work. In 2024, BHP and Fortescue both announced workforce reductions across nickel and iron ore operations, with many roles based in or commuting from Perth. Engineering firms and mining contractors in the city have trimmed staff as new projects stall. For heavily indebted households who borrowed at the peak of the boom, even a modest loss of income or overtime can tip the balance. There is no safety net of alternative high-wage jobs if mining slows. Perth's mortgage risk is not just about prices. It is about the volatility of the paychecks that keep repayments flowing. Brisbane's outer growth belts are under pressure from all sides. In 2024 and 2025, more than 10,000 properties were newly classified as flood-prone in the city's updated maps, with over 2,000 homes shifted into higher risk categories overnight. For families in Logan and Ipswich, these changes have real financial consequences. Insurance premiums have surged, sometimes doubling in a single renewal, and lenders are tightening requirements or refusing loans for homes without adequate cover. Digital Finance Analytics now ranks Logan and Ipswich among the top mortgage stress hotspots in the country. Combined with soaring transport costs and high household debt, the monthly budget squeeze is relentless. For many, the risk of flood is now matched by the risk of financial drowning. Western Sydney now records the largest number of households in mortgage stress outside of Melbourne. In suburbs like Campbelltown and Blacktown, thousands of families are spending more than 40% of their income just to keep up with repayments. Digital Finance Analytics and Roy Morgan both rank these areas among the country's most financially stretched, with stress counts rising faster than the New South Wales average. Our PRA data shows that arrears in Western Sydney's outer suburbs are increasing, even as the rest of the state remains more stable. The region's dense population and high debt loads mean that a single missed payment can quickly escalate into a cascade of hardship applications and forced sales. In these commuter belts, the combination of modest wages, high transport costs, and rising utility bills leaves little margin for error. For many, the numbers have become impossible to manage, turning Western Sydney into an epicenter of solvency risk. In Melbourne's outer growth corridors, the numbers tell a sobering story. Suburbs like Melton and Clyde North are now at the forefront of household insolvency risk, where large loans taken out during the pandemic boom have collided with falling property values. CoreLogic data shows these outer ring areas have recorded some of the steepest declines, with days on market stretching out and price reductions becoming the norm. For many families, the dream of new home ownership has turned into a financial trap, as repayments have doubled while the value of their home slips below what they owe. The problem runs deeper than prices alone. A wave of builder insolvencies across Victoria has left a trail of unfinished homes and widespread construction defects. Many of these houses are plagued by poor insulation and high running costs for heating and cooling, adding hundreds of dollars a month to already stretched budgets. Insurance premiums have risen too, especially for properties with unresolved defects or incomplete works. In these suburbs, the promise of affordable new housing has given way to a cycle of debt and declining asset quality, leaving households with few options but to hang on and hope the market turns. In inner Melbourne, the housing market is facing a crisis that radiates far beyond its city limits. The apartment sector, once a magnet for investors, is now awash with vacant units. According to SQM research, the vacancy rate in inner Melbourne has jumped from 1.1% to 2% in just 12 months, an 82% year-on-year surge. This is not just a blip. It signals a fundamental reversal in demand, with thousands of apartments sitting empty as tenants and buyers retreat. CoreLogic data shows a growing number of off-the-plan apartments reselling below their original purchase price. For investors who bought at the peak, many are now exiting the market, accepting losses to stem the bleeding. The consequences of this exodus are visible in every metric that matters. Rental listings have ballooned, while asking rents have begun to soften for the first time since the pandemic. Developers caught with excess supply are shelving new projects or offering steep discounts to clear stock. The glut of unsold and unrented apartments is pushing values down across the board, eroding equity for owner-occupiers and investors alike. This wave of vacancies and forced sales is not contained to a handful of troubled buildings. It is spreading across the inner city, threatening to drag down surrounding suburbs and amplify financial stress in the broader market. As more investors rush for the exits, the risk of widespread contagion grows. Melbourne's inner metro now stands as the epicenter of Australia's mortgage crisis, not just because of falling prices, but because the collapse in demand has left no floor under the market. The city's leverage, once its strength, now threatens to pull the rest of the country into deeper waters. Across all 10 cities, one pattern stands out. When housing debt grows faster than local wages, the system turns brittle. It's not just rising rates, it's a structural mismatch locking families into impossible choices. This isn't a temporary squeeze, it's a warning about financial resilience in modern Australia.